Most people are misreading XRP right now. While retail sentiment remains near cycle lows, several of the biggest developments for XRP are happening in regulation, institutional infrastructure, and liquidity discussions, not in the price chart. In the next few minutes, we'll break down a new XRP valuation framework, the latest Clarity Act timeline, why the XRP velocity debate may be flawed, and what institutional adoption trends could reveal about where the market structure is actually moving. See, one of the biggest misconceptions in crypto today is that XRP's price is being held back primarily by velocity. The traditional argument is simple. If XRP moves quickly through the network, participants don't need to hold much of it, limiting price appreciation. But a growing group of analysts is challenging that assumption, ladies and gentlemen. Their focus isn't velocity, it's liquidity depth. And that distinction changes the entire conversation. Because if XRP were ever used to facilitate large-scale global settlement flows, banks and institutions would need extremely deep liquidity pools to process transactions without significant slippage. In other words, the question isn't just how fast XRP moves. Let this sink in, ladies and gentlemen. It's very important. The question is whether existing liquidity could support institutional scale activity efficiently. At the same time, regulators in Washington are approaching a critical window for crypto legislation. Europe is accelerating digital asset adoption under clearer rules, and new valuation models are attempting to quantify what different levels of XRP adoption could theoretically imply. And when you connect those pieces together, a very different picture starts to emerge. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. For years, critics of XRP have argued that velocity limits price appreciation. That logic sounds simple. If a token moves quickly through a system, users don't need to hold large amounts of it. Therefore, price remains suppressed. But a growing group of analysts believes that argument misses something critical: liquidity depth. Imagine trying to process billions of dollars in foreign exchange transactions through a shallow pool of liquidity. Every large trade would create enormous slippage. Prices would move violently. Spreads would widen. Settlement efficiency would deteriorate. Institutions cannot operate that way. Global banks require stability, predictability, and enormous liquidity. According to perspective, the issue isn't velocity. The issue is depth. See, if XRP were eventually used to facilitate major settlement flows, liquidity pools would need to become dramatically larger. Some analysts suggest that a significantly higher asset valuation could help create the depth required to absorb institutional scale transactions while maintaining tighter spreads. This is massive. Let this sink in. This is where the concept of systematic revaluation enters discussion. Not because someone decides the price should be higher, but because larger financial systems may require deeper liquidity infrastructure. Whether that happens remains uncertain, but it represents a very different way of thinking about XRP valuation. And it's becoming an increasingly important conversation. Let's go deeper. A new quantitative framework has been circulating among XRP analysts. The model attempts to estimate valuation based on global payment activity, circulating supply, and token velocity. The assumptions include approximately 61.22 billion XRP in circulation, and velocity estimates between 10 and 20. Using those variables, several adoption scenarios emerge. Scenario A, moderate integration. Global payment volume approximately 10 trillion annually. Estimated XRP valuation range, $8 to $16. Write this down. This assumes meaningful adoption, but not full-scale institutional integration. Scenario B, high global integration. Global payment volume reaches roughly 100 trillion. Estimated XRP valuation range, $82 to $164. Write this down. This represents substantial participation in global settlement activity. Scenario C, advanced settlement infrastructure. Transaction volume expands towards 720 trillion. It's massive. Estimated valuation range, $589 to $1,177. Write this down. See, ladies and gentlemen, at this stage, XRP functions as major infrastructure rather than simply a digital asset. Scenario D. Extreme tokenization environment. Global economic activity exceeds $1 quadrillion in tokenized settlement and asset movement. Estimated valuation range, $816 to $1,634. Write this down. Again, these are model outputs, ladies and gentlemen, not predictions, not guarantees. But here's where it gets interesting and spicy. The frameworks shifts the conversation away from speculative hype. Instead, it asks a different question. What level of economic activity could the network support? That distinction matters because adoption and speculation are not the same. Price can move without adoption, and adoption can grow without and before price responds. Price is reacting, systems evolving. Those are two very different processes, ladies and gentlemen. See, if all of these developments are happening, why does sentiment feel so bearish right now? Because psychology often lags reality. Many retail investors entered crypto expecting rapid gains. When those gains fail to materialize, immediately, frustration follows. Social media amplifies the negativity. It's like living in an echo chamber, unfortunately. Some commentators even argue that sentiment today feels worse than during the aftermath of the FTX collapse. But that comparison deserves context. The FTX collapse erased billions, destroyed trust, and forced countless investors out of the market entirely. See, today's environment is different. Regulatory progress is improving, institutional participation is expanding, and infrastructure continues developing, ladies and gentlemen. This is so important. Yet sentiment remains weak. Why? Because human beings experience recent pain more intensely than distant progress. Investors often focus on what happened this month, not what has changed structurally over the last 3 years. And that's where opportunities sometimes emerge, not when everyone is optimistic, but when structural improvements occur beneath widespread pessimism. Let's step back for a moment. In 1844, Samuel Morse sent the first long-distance telegraph message. At first, people saw little practical significance. Communication already existed through letters and messengers. Why change? But over time, the telegraph transformed global commerce. Information that once took weeks could travel in minutes. Think about this for a second. Markets became more connected. Trade accelerated. Financial systems adapted. The technology wasn't valuable because of the wires themselves. It was valuable because it reduced friction. Crypto infrastructure faces a similar challenge today. The asset isn't necessarily the entire story. The reduction of settlement friction may ultimately become the bigger narrative. And history shows that systems reduce friction often before foundational. Remember that. Another major trend affecting crypto is artificial intelligence. Over the last several years, enormous sums of capital have flowed into AI companies. Investors have concentrated resources into a relatively small number of firms, building infrastructure, chips, data centers, and advanced models. Some crypto investors see this as competition. Others see it differently. They see convergence. AI agents increasingly require digital systems capable of transferring value, verifying information, and coordinating activity. Blockchain technology may provide pieces of that infrastructure. No one knows exactly how the relationship evolves, but the possibility remains significant. Instead of AI replacing crypto narratives, AI could eventually amplify them. See, the market often treats these sectors as competitors, yet future integration may prove far more important. Now, this is what most people miss, unfortunately. Capital rotations happen constantly. Money rarely disappears. It relocates. Today's AI enthusiasm does not automatically eliminate tomorrow's crypto opportunity, does it? See, despite all the excitement around AI, Bitcoin continues following patterns many investors recognize. Historically, Bitcoin has experienced powerful expansions followed by significant corrections. These cycles have repeated multiple times, yet each cycle looks different. Yet similarities continue appearing. Current market conditions resemble prior retracement periods following major advances. That doesn't guarantee future outcomes, but many analysts remain focused on long-term cycle structures. The key takeaway is simple. Temporary weakness doesn't necessarily invalidate broader trends. Short-term noise, long-term structure. That distinction remains essential, especially in volatile asset classes. Our second historical example comes from 1944. Representatives from dozens of nations gathered in Bretton Woods, New Hampshire. The goal was ambitious: create a new financial network and framework following global instability. The resulting system reshaped international finance for decades. What mattered wasn't merely the agreement themselves. It was the confidence those agreements created. Markets function best when participants understood and understand the rules. That lesson remains relevant today. It's so important. Regulatory clarity can sometimes be more powerful than regulatory perfection. That's why I always say progress, not perfection, ladies and gentlemen, and pay attention to what's quiet. See, institutions simply need enough certainty to allocate capital. And that is exactly why crypto legislation matters. While the United States debates regulatory frameworks, Europe has already made substantial progress through MiCA regulations. The results are becoming increasingly visible. Financial institutions that previously waited on the sidelines are now accelerating digital asset initiatives. Custody growth has reportedly surged dramatically year over year. Banks are entering the space. Asset managers are expanding services. Infrastructure providers are scaling operations. The reason is straightforward. Clearer rules reduce uncertainty, and reduced uncertainty encourages participation. This is massive. The real shift came when institutions stopped asking whether digital assets would exist and started asking how to integrate them. That transaction changes everything, ladies and gentlemen. Japan continues providing valuable insight to crypto adoption. SBI has now surpassed 2 million registered accounts. The company has expanded digital asset initiatives while incorporating Bitcoin and XRP into shareholder loyalty programs. That development matters because it demonstrates practical integration, not theoretical discussions, real-world implementation. And at the same time, SBI plans to close its Bitcoin mining pool by July 31st. It's massive. Given its position among major mining participants, the decision attracted considerable attention. Whether this represents strategic refocusing or broader operational adjustments remains a topic investors are closely watching. Either way, institutional behavior often reveals priorities before narratives catch up. One of the least discussed developments involves money market funds. Industry participants increasingly describe blockchain-style infrastructure as new financial rails. These rails could improve settlement efficiency. This is really important, ladies and gentlemen. Reduce operational friction, and potentially create entirely new categories of financial products. Let that sink in. Think about this. Really, let this sink in and think about this. See, some of the world's largest pools of capital are exploring technologies originally associated with crypto and startups. The conversation is no longer about replacing traditional finance. It's increasingly about upgrading it. And that distinction may prove critical. The current digital asset transition resembles the evolution of shipping containers in global trade. Before standardized containers, transporting goods was slow, expensive, and inefficient. Once standards emerged, global commerce accelerated dramatically. Blockchain infrastructure could play a similar role, not because it's flashy, but because standardization often unlocks scale. Recent developments involving Tether have also drawn attention. Revolut's decision to begin delisting USDT raised questions throughout the market. Stablecoins have become essentially liquidity mechanisms across crypto ecosystems. Any pressure affecting major stablecoins' inevitability attracts scrutiny. Combined with broader market weakness, these developments have contributed to investor caution. Yet markets rarely move because of a single factor. Multiple forces often interact simultaneously. Regulation, liquidity, macroeconomics, institutional behavior, all influence outcomes. Another closely watched story involves MicroStrategy. The company's strategy of using debt to acquire Bitcoin created enormous upside during favorable conditions. But leverage always introduces complexity. Leverage is nasty at times, ladies and gentlemen. Now investors are examining future obligations and available options. You have to pay attention to this. The company could choose to sell assets, issue additional shares, or pursue alternative financing strategies. Whatever path emerges, the situation highlights a timeless financial principle. Leverage magnifies outcomes, both positive and negative. And markets pay close attention when large participants face difficult choices, ladies and gentlemen. I want you to think of today's crypto market like the construction of a medieval cathedral. Most people only notice the finished structure. if you paid attention to decades of foundation work happening underneath. Why I tell you, you've got to pay attention to what's quiet. Finance is like watching paint dry on the wall, ladies and gentlemen. Crypto infrastructure may be experiencing a similar phase. The visible price action captures attention. The underlying construction receives far less recognition. Yet foundations often determine the future strength of the entire structure, ladies and gentlemen. See, when we zoom out, a pattern begins to emerge. Regulatory frameworks are advancing. Institutional adoption is growing. Europe is accelerating. Japan continues experimenting. Financial infrastructure is evolving. AI investment is expanding. And blockchain technology remains part of the broader conversation. Does this guarantee higher prices? No. Markets remain uncertain. Risks remain real. But the structural story continues developing. And that may be the most important takeaway. Because while prices fluctuate daily, systems evolve over years. Short-term noise creates emotional reactions. Long-term structural creates transformational change. Prices reacting, systems evolving. Investors who understand that difference may gain a clear perspective on what comes next, ladies and gentlemen. So here's what we're watching. The Clarity Act timeline, the XRP liquidity and valuation debate, institutional adoption across Europe and Asia, money market fund modernization, stablecoin developments, Bitcoin's ongoing cycle, and the growing intersection between AI and blockchain infrastructure. Together, these developments may help shape the next chapter of digital assets. The question isn't simply where prices go next. The bigger question is whether the financial system itself is gradually moving towards blockchain-enabled infrastructure. And that story is still being written. Ladies and gentlemen, if you've enjoyed this breakdown, make sure to subscribe to the channel, like the video, and share with someone following XRP, Bitcoin, and the future of digital finance. And let me know in the comments, do you think the Clarity Act passes this year? And if it does, what impact could it have on XRP and the broader crypto market? Thank you always for watching, ladies and gentlemen. I'm going to see you in the next one. Happy Sunday morning, everybody. At the time of this recording, a lot going on. Talk about real fast. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. Remember, one solid tip in the pits can easily pay for your entire subscription. If you want the deeper macro research and you want to learn how to take advantage of all this, come and join over 600 active traders and investors in the Patreon, the Crypto Public Desk Monthly. Ladies and gentlemen, there is so much happening right now, and I see people's frustrations. I do, and I understand it, but part of being a financial mercenary is doing the same thing over and over again when no one's paying attention except for yourself. Because when I learned to trade, social media didn't exist. I don't see how social media has any impact on trading except for the release of news. That's why I always say death of 1,000 paper cuts, death of 1,000 headlines. I'm going to go over real fast what we're watching and why, okay? You have to understand something. This is not going to happen overnight. See, I think the second half of 2026 could catch investors off guard. None of this is financial advice. This is just my own opinion, and it retains our organization any capacity. Part of being the remora means we don't get cut up like sushi. We're patient. We watch. We have the satellite perspective. Most people want to see things happen fast. That doesn't happen in finance. See, there's a million people to pay attention to who can say A or B. There's people who are long and take advantage of long. Then there's people who go short and they take advantage of accounting and they itemize an idea that no one else is paying attention to. Each makes sense to themselves, right? This is going to take time. But the biggest thing here is if you have nothing in this, it won't matter. Again, the attacks in the ME are accelerating. We're positioned for this. If you want to learn how to take advantage of the coming chaos for the reacceleration of kinetic action in the Middle East, join the Crypto Public Desk Monthly, ladies and gentlemen. We take advantage of everything. But listen to me, and this is not financial advice, just my own opinion or retains any capacity. See, the second half of 2026, we think is going to catch a lot of people off guard. See, one of the biggest mistakes we see is investors making assumptions that today's market consensus will continue indefinitely. Markets rarely reward crowded positioning, and right now, optimism has become the dominant narrative. See, ladies and gentlemen, for 40 years, the traditional 60-40 portfolio of stocks and bonds was considered the gold standard for asset allocation, but that environment has changed dramatically. a more balanced allocation across equities, fixed income, commodities, and cash has significantly outperformed expectations this year. This demonstrates that diversification still matters even during a period where only a handful of mega cap technology companies have driven much of the market's gains. See, this tells me something very important. Investors should become not complacent simply because market leadership has been extremely concentrated. See, despite the strength that we're seeing in equities, we're paying close attention to financial conditions, which continue to become more restrictive. Real yields on long-term U.S. Treasuries have climbed to levels not seen since the global financial crisis. Increasing borrow costs throughout the economy, higher real interest rates eventually create pressure on speculative investments, highly leveraged businesses, and risk assets that depend on cheap capital. We're already beginning to see signs of that pressure, ladies and gentlemen. Private equity, private credit, and other leveraged investment vehicles have struggled, while speculative areas of the market, particularly small cap technology stocks in Asia, have experienced sharp corrections after enormous rallies. You should be writing all this down. I can't believe I'm giving this away for free. But even so, investors haven't become defensive yet, and they should be. See, instead, money continues rotating into other areas of the market rather than leaving equities together. I always tell you, money flows from the place it can make its short-term numbers. See, as long as leadership remains intact and broader market trends don't materially deteriorate, institutional investors appear willing to continue buying dips instead of reducing overexposure. One market I am watching very closely. If there's one international market that deserves investors' attention, it's Japan. I always tell you, got to pay attention to Japan, ladies and gentlemen. Japanese bank stocks have surged over the past several years as government bond yields move dramatically higher. At the same time, global financial stocks have quietly become one of the strongest performing sectors, benefiting from both higher interest rates and increasing adoption of artificial intelligence across financial services. However, I believe Japanese banks could become one of the earliest warning signs of global settlement risk begins to deteriorate. I always tell you, the widow maker, Japan, watch this so you don't get caught up like sushi, ladies and gentlemen. Should higher Japanese bond yields eventually start hurting financial institutions instead of helping them, that would represent an important shift in market psychology and could signal a broader move away from risk assets worldwide. So you have money continues flowing into risk assets. It just does, ladies and gentlemen, because it has to. Institutional fund flow data remains remarkably constructive. Recent weeks have seen substantial flows into equities, along with continued allocation into bonds and money market funds. Technology continues attracting enormous amounts of capital and remains on pace for one of the strongest years of institutional buying on record, baby. Pay attention to this. Chinese equities have also experienced renewed investor interest after months of underperformance, while financial stocks continue attracting fresh capital. See, these flows reinforce what I'm seeing across the broader market. Investors remain overwhelmingly optimistic. See, there's virtually no bears left, and the biggest takeaway from current positioning is simple. Almost nobody expects anything to go wrong during the second half of the year. What can go wrong, right, baby? What can go wrong here? Oh my God, a lot can go wrong. We may have that please return to your seats, and buckle your seatbelts, we're about to lose cabin pressure. The consensus rests on four major assumptions. One, investors believe the economy will avoid a slowdown. The dominant expectation is that economic growth will remain resilient with no meaningful slowdown. That's proof's correct. Investors are likely to continue favoring equities and cyclical assets while avoiding long-term duration bonds. The prevailing mindset has essentially become, why own bonds when stocks continue moving higher? What could go wrong, right? Number two, markets don't expect additional Federal Reserve rate hikes. The back and forth. We go over this. Ladies and gentlemen, if you're still here, you should like the channel because at the end, you make it to the candy Italian ice. But this is one of the big narratives we go back and forth with. You know, this is crazy. You got to stay with me. Another widely accepted assumption is the Federal Reserve will avoid raising interest rates further, particularly ahead of midterm elections. Although inflation remains elevated, many investors believe policymakers will be reluctant to tighten financial conditions enough to disrupt markets. Interesting. Central banks around the world have actually delivered more rate cuts than hikes this year, reinforcing the perception that monetary policy will remain relatively supportive. Number three, Trey, no one expects AI spending to slow. Artificial intelligence remains one of the strongest investment theses and themes in global markets. Print it to win, it's coming, baby. None of this is financial advice, in my opinion, or intended any capacity. Consensus forecasts call for hundreds of billions of dollars in AI infrastructure spending this year, with expenditures expected to exceed $1 trillion annually in the near future. Think about this, $1 trillion. This is nuts. Investors continue assuming hyperscale technology companies will maintain the pace without interruption. Number four, baby. Marketers don't expect a major political shift. The final assumption involves U.S. politics. Most institutional investors don't expect a sweeping change in congressional control following the upcoming midterm elections. That expectation has become another important pillar supporting current market sentiment. So the contrarian trades we're watching, when everyone shares the same outlook, I begin looking for scenarios that could actually surprise the market because the sushi may be coming in fresh sushi may be coming. These surprises often create the best investment opportunities. A slowing economy. What happens if economic data begins weakening even modestly? That markets could quickly rotate into assets that have been largely ignored. Long-term duration government bonds, high dividend stocks, consumer staples, and other defensive sectors could outperform as investors reposition for slower growth. Unexpected Federal Reserve tightening. Another major surprise would be additional Federal Reserve rate hikes. Historically, periods where inflation approaches or exceeds the unemployment rate have often been accompanied by further monetary tightening. You should be writing all this down. I am taking the PhD out of PhD here for you on this Sunday morning. If inflation remains stubbornly high, the market may be underestimating how aggressive policymakers could ultimately become. In that environment, I would expect a strong U.S. dollar, a flatter treasury yield curve as investors price in tighter policy, a reduction in AI capital spending. Perhaps the biggest overlooked risk involves artificial intelligence investment itself. Today's market assumes hyperscale technology companies will continue increasing capital expenditures indefinitely. This is big. I'm not convinced that any of this is guaranteed, ladies and gentlemen. This is my own opinion and our organization and retains any capacity, not financial advice whatsoever. Rising borrow costs, deteriorating free cash flow, growing debt insurance could eventually force management teams to moderate spending. See, if that occurs, leadership with technology could change dramatically. Semiconductor companies that have benefited from the AI build-out could underperform, while software companies established mega-cap technology firms may become relatively beneficial. There's some political risk. Investors appear relatively comfortable with current political expectations heading into the midterm elections. If election outcomes differ significantly from market assumptions, we could see a meaningful declines in treasury yields, a weaker U.S. dollar, increased volatility across equities. In that environment, precious metals, particularly gold, once again could become an attractive hedge against uncertainty. See, if you understand the presidential market cycle, ladies and gentlemen, it's very important. Look, going back over the last 150 years of market history, presidential terms have displayed remarkable consistent patterns. Historically, the first year of a presidency tends to produce below average market returns as new administrations implement difficult policy decisions. The second year has often become the weakest economic period, reflecting economic adjustment and particularly uncertainty surrounding midterm elections. The third year historically delivered the strongest gains as fiscal stimulus and pro-growth policies begin supporting economic activity. The fourth year has also tended to generate above returns as governments seek to maintain economic momentum heading into presidential elections. So far, the current administration has outperformed these historical tendencies. However, history also reminds us that the midterm elections frequently represent one of the most important turning points of financial markets. That's why we're paying close attention to political developments over the next several months. My bottom line, the greatest risk isn't widespread fear, ladies and gentlemen, it's widespread confidence. Markets are largely priced for continued economic resilience, accommodative central banks, uninterrupted AI investments, and political stability. So when expectations become this one-sided, investors should be preparing for outcomes that consensus are not pricing in. History has repeatedly shown that the largest market moves often occur when everyone believes the future is already written. As institutional analysts, and financial mercenaries, we believe disciplined investors should spend less time chasing today's winners and more time identifying tomorrow's unexpected catalysts. So we're watching next unemployment report, especially the relationship between payroll growth and unemployment rate, treasury yield movements following major macroeconomic releases, or the software continues outperforming semiconductor infrastructure, Japanese yield curve steepening and its implications for financial institutions, signs that AI productivity gains may be showing up in labor costs, whether macroeconomic releases continue generating large cost assets. Now, why this is so important, ladies and gentlemen? Markets appear to be entering a regime where incoming economic data matters more than policy guidance. If that transition continues, investors should expect structurally higher volatility, faster sector rotation, a greater dispersion between winners and losers. In that environment, simply following headlines becomes less effective. Understanding how macro data changes policy expectations, how this changes ripples through rates, currencies, equities become more increasingly valuable for more investment decisions. Ladies and gentlemen, most investors waste time consuming information. Very few spend time analyzing information. That difference determines performance, ladies and gentlemen. See, understanding where institutional capital is flowing provides insight into what professional investors believe will matter over the next several quarters, not just a few days. So when you focus on positioning, flows, probability, and structural themes instead of headlines, you stop reacting to markets and understand them. And investing, understanding almost always revives before opportunity becomes obvious. So you have to understand the shifts before they become consensus and dramatically improve portfolio construction, risk management, and long-term capital allocation. Investors who consistently outperform are rarely the ones reacting to headlines, ladies and gentlemen. They're just not. They're usually the ones identifying structural trends while everyone else is still debating short-term noise. The people understand those dynamics before the crowd usually don't need to chase opportunities. They don't. They're positioned for them. That's why the ones are positioned early, not randomly, but intentionally. I want to say something. I love the comments here. A lot of people feel silly, negged out. I'm going to say this again. I know it's felt like every man and woman by themselves for a minute, but we're going to get through this. A little solidarity goes a long way. You know, when you look at the demographics of the crypto republic, most of our viewers are 40 and up, have sizable investments, portfolios, hardcore traditional investors. Look, when you pay attention to what's quiet, you reap the benefits. Investing is like growing and farming. You have to plant seeds, farm it, and then harvest it. For everybody who thinks that they feel silly right now, I don't know the title of the video when I went over one of our first rants, and I'm not an AI person, I'm a real person. Everybody in the Zoom calls in the Crypto Public Desk Monthly knows this. Look, when the migrator rant, that's months back, when I went out for people that retain any capacity, being financial mercenaries, looking at the wheat crops over 2 decades ago. And we had first had the migrator plague and locusts. So we're paying attention to another plague right now that's affecting the United States in crops. We're going to go over that in today's Zoom call. You have to be patient. You're going to be mocked and laughed. That's why people who share everything on the internet about their position sizes and everything, I don't quite understand that. When you've done your research, the rec, and this video has gone a little bit long, and if you're still here and you're not subscribed and you're not in the Crypto Public Desk Monthly or even the free tier, you should. It'll help you. You're amongst friends and like-minded people. That's why I say sit me at the lunch table where people are learning, talking about theories, ideas, trying to get ahead, because great minds are mocked. I learned from people on the floor of the New York Mercantile Exchange that had to do some of the strangest things to accumulate money to buy their seat on the floor. And some of the families, it's amazing. So to me, I take every data important that I can get. The migrator, what I learned to that whole situation. It took time to identify the situation, let the situation unfold, and harvest it. The same way it took time for us to develop concessions, build a refinery, build a pilot refinery, get the solvent, get the licenses, get the feedstock, put it into play, offset it, trade it, run through the state-run refinery, boom. This does not happen overnight. So for everybody who thinks that BTC and Ethereum are going to be better than XRP, ladies and gentlemen, we're the XRP army. Yeah, we're the wolf pack. And I tell you this all the time here, okay? This part of the XRP army, we're the wolf pack. The wolf's not the mightiest animal in the jungle, but it's not like the lion and tiger at the circus doing tricks. No. So if everybody who thinks their kid is smarter than them or laughing at them because they got the BTC or ETH and it's doing this, blah, 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 blah. You know how early we are that things are changing? I could give you a million reasons of why. It was no different when we first started doing solvent extraction, electrowining. Years ago, it's industry standard in places now. People thought we were nuts when I said, oh, by the way, I got a rock oil. I'm going to wash it in an autoclave, which is a fancy word for a dishwasher. I'm going to spray acid on it. I'm going to leach things out. People thought we were nuts. It's industry standard in places now. When you're early, you're going to be mocked, but you will have the last laugh. Don't get caught up like sushi here. You know why you're doing this. You see the writing on the wall. I've seen too much manipulation in my lifetime to understand that the powers that be don't want certain events. Manipulation happens in markets. Wrote a whole article about this in the Patreon. Again, I'm not going over any of this. Is not financial advice, my own opinion. I love you all, ladies and gentlemen. I'm going to see you on the front lines. Have a blessed Sunday. I'll see everybody at 2 o'clock on the Zoom call. Love you all. Don't get caught up like sushi. Got to get that Gucci conviction, that Gucci clarity. The more someone mocks you, your conviction, your Gucci conviction should be going higher. Your Gucci clarity going higher. Because you're not going to get cut up like sushi. Because you know what's at stake here. Patience. It pays to be patient, ladies and gentlemen. I love you all. I'll see you on the front lines. This content for information, educational purposes only. It's not financial advice. Always do your own research and consult a financial advisor. Never invest money based off of a YouTube video. Final thoughts. Ladies and gentlemen, if you want to see how we're going to take advantage of the coming chaos and disruptions of all commodities, come and join the Crypto Public Desk monthly. One good tip from the pit pays for everything. I love you all. I'll see you on the front line, ladies and gentlemen.